Okay, I'm going to be toggling back and forth between the chat here and my screen, but we're on time, so we'll get this session going. Really excited to connect with everyone, and today we're going to be talking about accounting considerations for small biz M&A, right? So myself, Patrick Dichter, and our Canadian representation, Subhash, has a lot more letters behind his name than me, a lot more expertise. So I'm going to start from the general considerations and American perspective, and then we're going to pass it to him as far as the intricacies of Canadian purchases, right? So as we get into this, it's like accounting. It's not the sexiest thing. It's not everyone's favorite thing of M&A. What's in it for me, right? Why should you care if you're going to go buy a business? It can impact a lot, right? So the parts that we're talking about today is going to impact how much you pay in taxes post-close. It's also going to impact whether or not you can see how healthy the business is, and know, as you undertake this biggest transaction of your life, if this business is performing well or not, right? So if I were in your shoes, I guess I've been in your shoes, but if I were in your shoes, these would be the biggest questions that I'd have pre-close, right? And these are some of the ones that we're going to answer today. Are my expenses during the search deductible, right? So due diligence, marketing, list building, maybe there's travel there. Are those deductible? If so, when? We'll talk about that. When I close, should I be an LLC? Should I be a C Corp? Should I be an S Corp? What corporate structure is best in terms of the entity and the tax implications for that? What if I want to have a holdco? Those are really popular right now, right, where you own multiple businesses. So we'll talk about that. Do I need an LLC now? So if I haven't closed, should I have an LLC in the meantime? And when's a good time to engage an accountant, right? Do I engage them before I close, after? We'll get into the real nitty-gritty specifics of that. So if you have additional questions, we do have time at the end for Q&A. Hit us with those, but these will be some of the questions that we answer that might be rattling around in your head. So the huge disclaimer, I live in New England. That's how they would say it in New England. The huge disclaimer. If you're in Canada, they might say, oops, sorry, I got to throw this disclaimer in. I'm not an attorney. That's my Canadian accent. But here's the real deal. This presentation is for educational purposes. Your situation is going to need to be catered to yourself and what you have going on. So please seek accounting and legal advice for your personal situation. And with that, we'll keep rolling. Okay. So quick background myself. I am, a fellow acquisition entrepreneur myself. Prior to that, I spent 7 years in a sales leadership role with a digital marketing company working with small businesses. And then I spent 3 years doing small business advisory. And I was always referring out bookkeeping, and I decided to go buy a bookkeeping and accounting firm. So I searched for about 10 months, and I acquired Appletree Business Services at the end of 2021. So since then, I've done 2 more acquisitions, and our team is up to about 25. And we specialize in small business bookkeeping and taxes and work all over the U.S. So that's my background. I'm one of you in the audience. I've been in your shoes searching. I'm if you're an operator now, I'm in those shoes myself. So let's just start with the bad stuff, right? Like in the past year, I've seen plenty of people who have bought businesses and just had messy accounting going on after they bought, right? So these are some of the ones that jumped out at me. So this is always a good lesson of what not to do, right? So I'll give some detail on each of these. So what not to do. This first one, don't buy a business from family without a purchase agreement and then intermingle bank accounts, right? I know it sounds crazy, but I saw somebody buy a home services business, bought from their uncle, didn't realize if it was a stock or an asset sale. And, it was so hard for them to understand how much they could pay themselves, understand how profitable the business was. And ultimately they were trying to get a line of credit from the bank and they couldn't because it was so messy. All right. So keep those things clean, especially if it's with family. Another don't plan on using the seller's accountant. I'm a little biased here, but I've just seen this go sideways so many times. The most egregious was somebody who was trying to buy a franchise and they really committed to this one deal and they went on and on and on thinking they were going to buy this business. And when they finally tried to get bank financing, they found out they hadn't paid taxes in years. The seller hadn't, right? And part of that delay and why they couldn't really uncover that was because they were planning to use the same accountant as the previous owner, right? So I think sometimes there's a misalignment of incentives there. And frankly, what I've seen 99% of the time is the new owner cares about accounting in a much greater sense than the previous owner, right? For a lot of these small business owners, accounting was like a matter of compliance and just checking the box. For somebody who's buying a business and probably using a big loan, you probably care about really good accounting a lot more than they did. So that's a big don't do. This third one here, I see a lot of people that wait 6, 9, 12 months after they bought a business to engage a real tax pro. And the problem with that is the balance sheet isn't stood up properly. So you might have heard Eric earlier talk about, asset sales. Well, you have to get a good, clean balance sheet that recognizes the value and the different asset classes from the business. And if you don't do that, you're never really going to be able to see the health of the business on the balance sheet. And when you go to do taxes, it'll really make a mess because you won't be able to depreciate things. And it just gets messier and messier the longer it goes on. So don't do that, right? So you could maybe have your bookkeeping somewhat done, but if the balance sheet isn't done properly, it's messy. So a few other don't do's that I've seen. I saw somebody buy a home services business and they integrated the CRM with QuickBooks Online and they messed it up and the revenue was getting double booked. So they thought the business was way up year over year. Turns out the CRM was just double booking revenue and then invoicing it from QuickBooks Online. And that was bad news when we had to unwind that and clean that up. So just be careful with your CRM integrations and get some support if you need it. Last couple, don't work with a bookkeeper if they're like 4 or 5 months behind and think that it's going to get better. Okay. So really good, solid bookkeeping should be done, closed out within 30 days of the prior month. And if they're months and months behind, it's just not likely to improve. So that's just something that I wouldn't mess around with. If I had bought a business, you need to have it up to date. And this last one, this is probably the most common one that I see. Don't try to do your own accounting, right? A lot of people that are in this small business M&A space, they might have they probably have a finance background, right? So they come from banking or they come from private equity and, they can build Excel models really well, but at the end of the day, it's not a good use of your time and you'll probably fall behind with it. So that's what I see all the time is like, it falls behind, you don't keep up with it, and then it just gets messy. And it's not a good use of your time as you're trying to do integration and work on getting to know your clients and your team. It's really just better off like outsource that to a pro and spend your time somewhere else. So those are the horror stories. Those are what not to do. Let's get into some of those other questions about how to do this well. Okay. So this first one, should I open an LLC for my search? The answer is yes. Simply like for legal and accounting purposes, yes. It's just plain and simple. As you're sending letters of intent, as you're drafting purchase agreements, you should have an LLC for your search. As you incur expenses there, right? Like legal expenses, due diligence, travel, marketing, you might be standing up a website, you might be paying somebody to do outreach. Those things can be deductible, right? You need to keep good receipts and you need to pay those expenses through the LLC. I'm not going to get into all the nitty gritty of the timing on when it's deductible and all that, but the long and short of it is yes, those are deductible. So make sure that you track that properly and set up a separate bank account for your search company. We'll keep rolling here. What entity should I be? So this is a big one. This is complicated. I'm going to give some high level perspective on this, but it's really going to depend on the type of deal that you buy, the capital structure there, right? Whether you're using debt, using investors, family money, your own cash, the depreciation, right? So if you're buying a services business or you're buying something that has heavy capital and equipment, right? Like if you buy a snow plowing business, that's going to change things. And ultimately your goals, if you're going to hold this business for a long time, or if you're trying to, sell it in 3 years or sell it in 7 years, all those things will make a big impact on your entity election, which impacts your taxes. Okay. The big thing that I would also say here is you can decide that later, right? So here we are in February. If I go out and start a search and I'm, you know, Western Acquisitions, right? Like if that's the name of my LLC and I decide to go buy, some company in, I don't know, Arizona, I can make that election later on, right? So like if you go from LLC to S Corp, you can decide later on, or you can decide, pre-close if you want to pivot to a C Corp. So you don't have to decide those things when you're sending an LOI. You probably want to be clear on it as you get close to closing, but just know that you have time for that later on. And some of these things can get really complicated if you do like a 338 H10. All those things really involve tax attorneys, and it can get really, really complicated. So we'll talk about some of the most common ones here. And I created some personas here. So this first one is Side Hustle Sam. So let's say, Sam has a W-2 job where he's an employee and he decides that he wants to buy a little e-commerce business on the side, or he wants to buy, a little landscaping business on the side. He might buy it for between 10 and 250,000. And his plan is maybe I'm going to hold it. I might sell it later on. I might try to grow it. Most likely Sam is probably going to be a single member LLC, right? So that means, he has an entity, it'll flow through to his personal tax return. That's the most likely scenario for somebody that's buying a small business, and it's going to be kind of a side project for them. The next person is Cash Flow Carly. So Carly decides she's going to buy a business and really optimize it for cash flow and lifestyle. And she might buy it for between, 250K to 3, 4, 5 million. And Carly says like, I'm going to make, 100, 200, 500 grand per year from this great little service business that I bought. And, this is what I'm going to do for the next 10 to 20 years of my life. And in all likelihood, Carly should really strongly consider being an S Corp. So a good rule of thumb is, if the profit to the owner is over 80 to 100K, it can make a lot of sense to become an S Corp. So what that means is you're an LLC that's taxed as an S Corp. To be compliant there, you have to make the election and you have to put yourself on payroll with reasonable compensation, right? So let's say Carly bought a commercial janitorial company that does, 4 million a year in revenue and 450K in cash flow. Carly might think that, reasonable compensation for somebody that owns that company is 100K, and then the initial 350K in profit that gets distributed out gets taxed less. So I'm simplifying this really quickly, but if you're buying something for cash flow and the profit, including your comp, is over 100K, you could consider an S Corp election. A common mistake that we see is somebody thinks they made that election and they didn't, or they make that election and they don't put themselves on payroll. You need to do that to, create reasonable compensation. So that's Cash Flow Carly. The next one, Platform Patty. So this is the roll up person, right? So they say, I'm going to go around and I'm going to buy up all the, landscaping companies in Florida and, roll them up, and maybe I'm going to sell them one day, right? So this one depends. You're likely going to be an LLC, single member LLC, or an LLC taxed as a partnership, or you might consider a C Corp. Okay. So this one gets more complicated. It depends on, if you're using debt or you're using personal cash or bank financing in terms of, how much basis you might create. Or if you're using investor money. And if you know that you really plan to roll these up together and like sell it for more than $5 million, more than 5 years later, you could consider a C Corp. So we won't have time for all of it today, but QSBS in the US is a way, if you're going to sell a business for over, $5 million, to not have as much capital gains tax liability, right? So if you're going to roll up all these landscaping companies and then sell them for $10, $15 million, 8, 10 years down the road, you won't get taxed on a certain amount of the capital gains that happen there, but you have to really do it as a C Corp, and you have to be careful with the way that you set that up. So that's Platform Patty. So you're probably going to be LLC, partnership, or a C Corp. The other persona is Holdco Hank, right? So there's a picture of Hank on the right, and he's like, listen, I'm going to have this, Berkshire Hathaway companies. I'm going to have a staffing company, and I'm going to have an accounting company, and I'm going to have a marketing agency, and then we're going to perform services, and then we're going to create a software development company and build apps, right? So like Hank is ambitious. He wants to sit back and kind of be the visionary and run multiple businesses. First thing I would tell Hank is like, chill out, man, go do your first deal. But in all seriousness, Hank would probably have an LLC at the holdco level, and then there'd be different entities below that. So that LLC may own the others, and they could be S Corps below it. It could be, other flow through entities that are LLCs as well. This one just gets really complicated, but you can always make holdco structures later. I know Eric and some of his team at S&B Law Group are really good at this, but what you need to do is like execute on the first one, and you could use your LLC from your search as maybe the holdco, or you can, change things later if you have, your landscaping company here, and then you want to have a holdco entity that owns that. So that gets more complicated, but that's definitely a structure to be considered if you're buying multiple businesses. So in a perfect world, what does this look like? If, it's February 17th and you know that you're probably going to close on a marketing agency in May, you should find your accounting partner now, right? So find your accounting partner early. And when I say accounting partner, I mean who you're going to work with post-close for bookkeeping and tax. I don't mean due diligence and quality of earnings. That's kind of a separate thing that you just use pre-close. If you're under letter of intent, right? So if you have an accepted LOI, that's a good time to start talking to your accountant and getting things going. Ideally, what we like to do at AppleTree, we like to get QuickBooks Online set up and have that ready a week before closing, so that as soon as you close, like all the information starts flowing, you can start to have a good picture of what's going on in the business. And the bookkeeping is not something that you have to worry about. What you don't want to do is like, wait 60 days post-close and then find your professional, right? It just gets harder and harder to clean up accounting the further it goes on. And then you have a lot of transactions that are happening early, and you might not be recognizing them in the right place with your bookkeeping. So in a perfect world, you have your account early, you set up QuickBooks Online pre-close, and then when you close, everything's flowing through, with your operating account. And if you're using any debt or lending, that's there. And then your balance sheet is clean and accurate from the start, so that you have a good picture on the health of your business. So that's a good way to do it. And then, you're set up better for having good, clean books, so you can see how the business is performing, that you have adequate debt service, and ultimately, like, you can get your taxes done well. And if you're in the U.S. and you're using SBA lending, the bank is probably going to review your file every year. So you want to make sure that you have really good accounting, so that your bank, is happy to work with you again on a future deal, or they don't put any, restrictions on your note. So that's the U.S. perspective. I'm going to stop sharing, and I'm going to pass it over to Subhash, if I can.
Thank you, Patrick. So that was a great presentation. So now I have very big shoes to fill, but I'll try my best. So here I am. My name is Subhash Sharma, and let me do the. Bear with me while I figure out the technology a little bit.
Yeah, so I picked share, and then I picked I'm on Chrome. It says you can pick tabs on Chrome, but
I hope you can see my presentation.
Not yet.
Not yet? I don't know what else to do. Okay, so
is there a button at the bottom to open share menu?
Open share menu, yeah. Share screen, yeah. Now I think it's getting there. Counting consideration for CTA, share. Now you can see it?
There it is.
Okay. So I will do the view and slideshow. So you can see it still?
Yep, we see the corporate structure slide.
Okay. So I'll go back a little bit here. Yeah, that's me. So my name is Subhash Sharma. So I run a small boutique accounting firm called Brownlee-based CPA Professional Corporations in Toronto. And we are a boutique cloud accounting firm. We do accounting, taxes, business advice, just like any other accounting firm. But we also provide business services under a separate company called Cadence Business Services. And value building is one of our major services we provide. And we do have clients in Canada, US, and internationally also. All right, so Patrick mentioned corporate structures. So we have very similar structures in Canada also. They are called slightly differently. So we have something called sole proprietors. This is an individual who wants to do side hustle kind of business, small business, part-time, not very serious just yet. And so they want to try it out before they spend any money on incorporation and other accounting fees and stuff. So they mostly start with sole proprietorships. And simplest structure to set up, I don't recommend it because it involves all the liabilities of business. So they're attached to your personal assets. So it's not a preferred vehicle, but yeah, there's no harm in starting there. But then soon enough, you want to go to corporation in Canada for sure. Then there is partnerships. So there are various kinds of partnerships in Canada. So we have the general partnerships, which has all the liabilities of sole proprietorships, only divided between individual partners. And then we have the limited partnerships. So lawyers, accountants mostly get into that. Then we have LLPs, JVs, cooperatives. So these are all kinds of partnerships. The partners or the members basically assume all the assets and liabilities of the business. I don't prefer this structure also. So my favorite, of course, is the private corporation. So private corporation is similar to the C corporation in US. And we have INC Limited and Corporation. So these are only the names, initials behind the company name, and they legally basically mean the same thing. So all the benefits, all the drawbacks are exactly the same, and basically the liabilities are limited in the private corporations. But there are two main kind of corporations, or rather three. So one of them is called CCPC. So this is basically owned by a Canadian resident. If a company is at least 51% owned by a Canadian resident, it's called CCPC, and basically it pays less tax. And the company which does not qualify for a CCPC is called any other private corporation. And then we also have holding companies which can hold shares of other companies, or they can hold shares of public limited companies, public listed companies, or they can hold any other assets such as real estates, stocks, bonds, mutual funds, or anything else, gold, jewelry, or whatever you want to hold in the company as the asset class. And then for jurisdictions, we have two kinds of companies here. So you can incorporate federally at the Canada level, or you can incorporate provincially at each province level. And again, there's not much difference, except in a federal corporation, your name is protected all over Canada, whereas in provincial corporation, your name is protected only in a province. Other than that, they're more or less similar. For taxes and other stuff, they're all very similar. Legal responsibility, legal liability wise, also they are similar. So for business taxes, sole proprietors pay taxes on their marginal tax rate. So if you're in the highest tax bracket in Canada, which is 53.5%, probably shocking for the US participants here. So you pay taxes based on your marginal tax rate. If your tax is 20% marginal tax rate, you pay 20%. If it is 53%, you pay 53%. Partnerships is very similar tax structure. So the income of the partnership flows through the partners, whether they're two or more partners, and then the partners pay taxes based on their marginal tax rate. So it could be 20% for one, 53% for the other partner. So again, not a very efficient, tax efficient structure to set up when you're setting up a company, but a lot of people do start there and then they progress to the corporations. And some partnerships are basically partnerships of companies. So a common example is accountants companies and lawyers companies. So we set up company, each partner will have their own corporation, and then those 2, 3, 5 corporations can become one corporation for active business. So, and that is also fine. In that case, the income flows through to those partnership companies. And then the most favored structure is the CCPC, the private corporations, which are owned by a Canadian resident, 100% preferably, or at least 51%. The company pays a lower tax because there is something called small business deduction. And in Ontario, they pay 12% tax. So each province has slightly different tax rate. Ontario has one of the highest, which is 12%. And then there are other private corporations, so they just pay tax on the general corporate tax rate, which is 26% in Ontario. So across Canada, it could be 1 or 2% difference, but it's in the range, in the ballpark of about 25% tax rate. So this 26% rate beyond $500,000 for a CCPC or private corporation from $1 stays the same, 26%. It doesn't go up based on the income. So whether your income is $500,000 for a CCPC or 10 million, it still says the 26%. And then there are some other requirements, statutory requirements. A buyer, when you're setting up a business, you should be aware of. One of the major one is the sales taxes. So it depends on which province you're setting up. So there could be GST, PST, or there could be HST, which is harmonized sales tax, combined GST and PST. If it is Alberta, it's only GST, there's no PST. So depending on where you are, the sales tax applies, and each province may have a separate GST, PST to worry about, so you need to be aware of those requirements. And the registrations are required if your revenue is over $30,000, and if you're in business, any serious business, it will be over $30,000 for sure. So we assume in the very beginning that you will be registered for sales taxes. Then there are payroll taxes, and these are basically payroll deductions from the employee salaries. So we call them EI, which is employment insurance, CPP, Canada Pension Plan, and tax deductions, which is federal tax and provincial tax, source deductions, which are paid to Canada Revenue Agency here in Canada. And then there's the workers' compensation. So in some provinces, it is called WCB. In Ontario, it's called WSIB, mean the same thing. So the company pays some premium, and the employees are protected if they get hurt on the job. So the WSIB or WCB of that province will pay for the rest of their lives if they get seriously hurt, or till they get better and be able to get back to work. And then there's the annual corporate returns. So federal or provincial, wherever the company is incorporated, each company is required to file an annual statutory corporate return. This is different from the corporation tax return. So this return basically informs the registering body if there's any changes in the address of the company or directors or officers of the company. And then there are the employment standards. So this is something serious. So if you are hiring employees or plan to hire employees, you're required to have or should have a thorough knowledge of the Employment Standards Act and the employment standard rules of that particular province, because they go by province. So there is minimum wages for each province. There is working condition requirements, hour of work, vacations, severance. So there are lots of rules in this area. So it's beyond the scope of this presentation. But there are a lot of rules, and usually any company which has over 10 employees should have a good employment lawyer on their side. So buying a business. So if you're in the buying position or considering buying a business, so you should consider a few things. One of them is the timeline. So I'm sure other speakers have told you about 1 year, 2 years, 6 months kind of period. So I would say you should have at least 6 months to a year to do your market research, due diligence, and this has to be done thoroughly, of course, in your own interest. So, of course, everybody does the financial due diligence, but you need to be very careful about few other things, which is the contingent liabilities and also the employee contract severance. And there's so many liabilities which are not shown in the balance sheet of the company, but you need to dig deeper. So those digging deep happens when you do a proper due diligence, and that's a process most accountants or some of the lawyers go through. It's very, very important for you to go through all this process, because this determines a lot of the outcome, how you will get this business and how you will perform in the business. And the other one is the valuation. So you need to consider the valuation not only on the quantitative factors, which is mostly EBITDA, SD. So you heard a lot from the other speakers, presenters, cash flows, the financial ratios, and all this stuff. So they are very important. I'm an accountant, so we do this for a living. But there are also some qualitative factors, and we do 8 key drivers of value. So we assess the valuation of a business on 8 key drivers of value, which I'll just show you in a minute. But that qualitative factors are equally important and sometimes even more important than the financial performance of a company. And you need to be aware of the integration. So when you buy a business, so how will you integrate the processes, the procedures, the system, the employees, the software? There are so many considerations to be given post-closing, which may not directly be like, I'm not involved directly in the accounting side. Other than the accounting side, there may be a lot of systems, but accounting itself, you need to be integrated thoroughly and properly with your existing system. And then there's the financing. So how will you finance the business? So are you bringing your own money? Some people do bring full money, not recommended. Usually you should have some kind of loans, and loan does two things. One, it releases your own money, keep some money in liquid in your business for operations, but also it gives you opportunity for somebody, a third party, to validate your business, the acquisition you're doing. So if somebody else looks at it, say a bank looks at it from a very detailed, experienced eyes they have, so I would think that's a good outcome to have. So some people say loan is not a good thing. I would say it's a good thing to have. Not a whole lot of debt, but some loan is a good thing to have in the business. And then there are the BDC loans. So BDC is a Business Development Bank of Canada. It's a government organization, and their mandate is to support small and mid-sized businesses, and they do financing for real estate, equipment, working capital, and purchase of business also. And again, they have consultants who will go through your business plan, your acquisition, your all the documents. So they will do part of the due diligence for you, and that is the value a loan brings into the business. And then there's the equipment financing, leasing. Banks and leasing company do it, so they don't do that kind of due diligence because they are securing their loan against the assets. And then there's also asset-based lending, inventory, AR. There are private companies such as Liquid Capital who will come in and give you loans based on your assets, but they will not do full due diligence as the normal banks or BDC would do. And then finally, the team of professionals. So I would like to say accountants are the most important people, but that's not true. So you must have a full team of professionals, and they're all equally important. So accountant, of course, but then broker, coach, M&A professional, wealth advisor, they're all equally important when you're structuring a deal, especially a bigger deal. All right, so I think I'm running in time. So selling a business. So if some of you are planning to sell a business or contemplate selling a business after you have bought it over a few years, so the valuation is based on 8 key drivers of value, and we have algorithms, we have systems for that to calculate versus just saying qualitative analysis. We do very detailed in-depth scoring system for valuation. And if you use our system, Value Builder system, you can realize 7 to 8 multiples of EBITDA. So normally you might have heard 3, 3.5. EBITDA is quite standard in the industry, in most industries. It goes up to 4 to 5 sometimes, like some of the industries. But by using Value Builder, you can basically double the multiples of EBITDA. And that is the value we bring using our algorithms. Another thing you need to be worried about when you're selling a business or you should consider selling shares versus selling assets. Now, if you came to me as a buyer of a business, I would say no, buy assets versus buying shares. But if you come to me as a seller of a business, I would say sell your shares, because there is something called lifetime capital gains exemption, as Patrick mentioned, QSBC shares. So we also has some similar structure here, and then there are a lot of rules around that. So you need to know the company is pure, it qualifies. The shares do qualify for small business deduction or lifetime capital gain exemption. So you have to be really careful what you're doing or structuring. But selling the shares will be probably a better outcome for you tax-wise. And you need to be aware that is the buyer qualified even before you start negotiation or deals. Okay, so here is the 8 key drivers of company value. So I think we have some time, so I can go over this. So basically, you need, we all know financial performance. So of course, the company has to be performing well. It must have enough cash flow, current ratio has to be good, and all those financial ratios have to be outperforming if you want to buy a business. But then there are other things like hub and spoke. Hub and spoke is the most important part of business which you want to look at when you're buying a business, or when you're selling a business. You want to increase the value of your business. This is one key factor. And what this basically means is, like, I as a business owner, I think I am the only one, I am the best one, I'm the best accountant in town, nobody can do better than me. So even though I may have 10 employees, all the employees come to me, all the customers want to talk to me, all the suppliers want to talk to me, everybody wants to talk to me, and I feel proud of it. As a business owner, I really feel good about it because I'm the most important person in the world. But when you go to sell your business, that's not a good thing, because as a buyer, when you're assessing this business, it's not a good business, because you need that person on board for another 1 or 2 years before a proper transition can happen. And still there will be some attrition. Some clients will not like to deal with you for whatever reason, right? So we don't go into the reasons why they don't like to deal, but there's always some attrition, 10-15%, depending on the nature of the industry. But ideally, you should be building something or buying something where the owner is not involved directly into the business. So the owner is supposed to be invested in the business, but the business should be able to run without the owner's input on a daily basis. Then there's the growth potential. So you may be buying on 3 multiples or 7 multiples of EBITDA, but EBITDA is always backward looking. It was last year or last 5 years, but that money doesn't come to your pocket. As a buyer of business, you want to see what is the growth potential of business. So that growth potential could be organic growth in the industry or in that particular business. So you can basically assess based on various market conditions. But then there is strategic buying. So that business may be aligned to your existing business or processes. So there may be additional growth potential which the seller is not realizing. So we need to basically assess the business on growth potential. And then there are a few other things. Another one very important is the customer score. Like NPS, Net Promoter Score, is a very common score these days. So every business, like if you buy any cable services or telephone, so these companies send you a Net Promoter Score saying how likely are you to recommend our services to your friends and family. And most people will say 5-star or 4-star or whatever. And then the Net Promoter Score basically has a formula behind. So it determines the overall score for a business. And if your score is good, then the value of the business is good. If the score is not good, that means the future of the business does not look good. Even if the past was very good, the company was making a lot of money, very profitable, a lot of cash sitting in the bank, but that business will not go very far if the customers are not giving it good marks, right? So we basically value the business on 8 key value drivers, and we have a scorecard. So if you want, I can share a link with you. Maybe I can do it in the chat after once we are doing the Q&A. And
this is great. Yeah, I was just going to say, let's try to hit the Q&A with these last 5-6 minutes.
Excellent, sure. So yeah, after this I'm done probably. Most likely this is my last slide. So yeah, Q&A time. Feel free to ask any questions from Patrick and myself.
Yeah, so feel free to put any more in the chat. I'm just going to rattle through these. So Paul Tierney asked a couple. What percentage of deals have a clean accounting system in your experience? It's, if they're working with a broker, the accounting has probably been cleaned up a little bit, but then you're probably arguing over add backs. But you might see with the previous owner that they're on like QuickBooks Desktop, or they didn't have good accounting until they were getting ready to sell. So it's kind of a crapshoot on what you'll see, which is why it makes sense to spend some money on due diligence if you're buying anything over $500,000 purchase price. Ilya asks, as you acquire more businesses, should you keep each business within its own LLC or under one? It depends. As I've bought multiple, they're all under one LLC now. If you're planning on operating under one and you want combined financials, I would think you'd probably want them under one. Paul asked, does the LLC need to be registered in the state where you're engaging these agreements? As you're searching, I think the LLC can be based where you live. If you acquire a business in a different state, you probably want to open a new LLC in a different state. Can you make S Corp election later down the road? Yes, you can. And why would it be a bad idea to elect S Corp under 100K? A lot of times the accounting fees and the compliance of payroll doesn't offset the tax savings if you're under 80 to 100K. That's just kind of a quick rule of thumb. Other people think it's a lower number. Some people say it's higher, but depends on your situation. Billy asked if flipped. Why is it bad? Not sure I understand that question. Yeah, Ilya, maybe if you ask the question a different way. Let's see, some other questions. Subhash, you have one here from Nitin. If the founder is the only person working in the business, do we still need to set up payroll?
Yes, simple answer is yes, because the owner can be paid only by two ways. So one is the salary, the other is dividends. So if you want to pay by salary, which is the preferred way to be able to save taxes, then it has to be a proper payroll setup, and you need to submit payroll deductions to Canada Revenue Agency each month if you're taking the money out each month, or whenever you take the money out of the company, you need to pay payroll deductions to CRA.
Good to know. Nunzio asked if a buyer wants to do asset sale and the seller wants to do, shares or stock sale, who usually wins? Probably the seller, but I've seen some people have success where they say, okay, I wanted to do an asset sale, you want to do a stock sale, I'm adjusting my price because of the tax impact. The seller probably isn't going to love that, but maybe you reduced your offer price by 10% because of the tax impact. But yeah. All right, a couple more questions. What value, from Joe, what value can you assign to the acquired B&E? Does it have to be the seller's net present value? So this gets into asset purchase price allocation. So let's say you're buying a landscaping company and, it's a $2 million purchase price, right? So of that $2 million, how much of the value do you want to assign to equipment versus goodwill? So you don't have to use the seller's net present value. You can look at what they were claiming on their taxes and what they might have depreciated. In your situation, you want the hard assets or the fixed assets to be high as possible, reasonably possible, versus goodwill because it favors you from a depreciation side. But it does need to be close to fair market value, right? So if you're buying 5 trucks in this landscaping deal and they've, depreciated those a lot and they don't have much left on the depreciation. But if you look at the fair market value of those trucks and it's, 100K for those trucks, you try to take the higher number there if it's fair market value. Hope that made sense. Judy asked, can you explain why purchasing a business in the US using 401k funds requires the company to be a C Corp? I don't know why that is, but I do know that that's a fact. There are companies that specialize in doing that as a ROBS type deal where you use 401k funds. I think it's because technically the 401k owns the assets until it's paid off, but I'm not totally sure. I've seen people do that. You do need to be very careful with the compliance on that. Paul asked, do you have any experience with substance abuse or assisted living space in Texas or Florida? Our firm does not. We do have clients in Texas and Florida, but we don't have experience in those industries yet. Marlon asked, are you using a DBA for each separate business under your one LLC? If somebody sues you under the one LLC, wouldn't they be able to get the money from all those businesses under it? I guess it depends. If you have an original asset sale and then you're buying more companies, those other assets would kind of go up under the one LLC most likely. So I guess, yeah, you have a little bit more risk and a bigger target on your back as those assets grow. So you want to make sure you have your legal buttoned up. I'm not an attorney though, so I don't know what the implications are if they're suing you with one LLC versus multiple. Any other questions here? Seems like it would be better to take the penalty on the 401k early withdrawal versus going with a C Corp for a small company. Paul, I don't know. Honestly, I don't have enough experience to be able to comment on that. I'm guessing it would depend on the fees and the deal size. So, yeah. I think Nunzio gave us the go-ahead to go a few minutes more if there's any other questions. Can you go to the last slide there, Subhash? So if you have more questions, put them in the chat, but here's our info. If we go down one more slide. So feel free to reach out to either of us.
Patrick, I'm sharing the link to this presentation as a PDF file, so anybody can download it. So
can you hit next slide on the presentation?
Actually, I can't. So you have taken over the.
Oh, all right. Well, feel free to reach out to either of us. We just put our contact info on there. My firm is Apple Tree Business Services. I hang out on Twitter and on LinkedIn if you want to find me there. Subhash, his firm is Bronte Bay.
I'm also putting my contact information in the chat here.
Okay.
So anybody feel free to reach out, and if there's any question, happy to help.
Couple other questions. Parag asked, what are some items looking back? I'm not sure I understand that question. Thank you, Nuns, for putting that in the chat. Thank you, Paul. Great questions there. Great comments. Oh, what are some items looking back you missed in your deals? I don't know what that means. Items in due diligence? Items in accounting? Items in due diligence. Yeah, if you're looking at the accounting industry specifically, feel free to reach out to me. Ultimately, I think it's like a lot of other service-based businesses. You're looking at what sort of team am I, going to be able to work with post-close? Is it quality revenue? Are they the ideal clients that I want? What systems and software do they use? That's a big one. Is it a transferable business, right? Some of these accounting firms are not very transferable, whereas others are set up well to be transferred to a new owner. Eric asked, can you speak to local CPA accountant versus online or out of state? Yeah, nowadays, I don't think it matters quite as much because so many businesses are creating nexus in other states, and people travel, and a lot of accountants are using software that helps us understand other states. There are intricacies from New Hampshire to Texas to California. We work nationwide, so we try to familiarize ourselves quickly with new states. But there are a lot of intricacies from a tax perspective. So I wouldn't disregard somebody that operates in a different state. I'd make sure, are they responsive? Are they familiar with my industry? And who am I going to be working with once I engage the firm, right? So it's a good question. What else? Any other questions? All right, this is great. If you have more, feel free to reach out to us. Our emails are in the chat. We put the presentation in the chat. I'm going to pop into some of the networking sessions and the expo, but thank you for having us. And that's it. Subhash, you have anything else?
Thank you very much, Patrick. So that was nice presentation.
All right. Scott is up next in 10 minutes. How to sell to a strategic partner. Those are the guys that pay big. So you don't want to miss that session. Strategics will pay more than independent.